This problem states that Nicole thinks her business, Nicole's Getaway Spa, is doing really well, and she's planning for a large expansion. With such a large expansion, Nicole needs to finance some of it using debt. She signs a 1-year note payable with the bank for $50,000 with a 6% interest rate. The note was issued on October 1st, 2017, and interest is paid semi-annually, and the end of Nicole's accounting period is December 31st. The requirement is prepare journal entries required from the issuance of the note until its maturity on September 30th, 2018. We'll start our journal entries first with the first issuance of the note. So this happens on 10/1/17. They told us right up here that a note is issued on that date. So from the company's perspective that's issuing the note, meaning they're receiving financing, we're debiting cash and crediting notes payable for the face value of the note, which is $50,000. Go ahead and label this notes payable short term because it's going to be due within the upcoming year. The next journal entry takes place on 12/31/17, and this is an adjusting journal entry to accrue the amount of interest that is owed up till this point. Remember, interest is paid semi-annually, and so we're not to that date yet, but it does tell us that the end of the accounting period is on December 31st. So we have to accrue the amount of interest owed. So our journal entry is going to be debit interest expense and credit interest payable. And the amount, the calculation, is going to be principal times rate times time. Here, principal is $50,000. The rate given us as an annual rate is 6%. And the amount of time that's passed is between October and December 31st. So we have October, November, and December. So we've got 3/12. And this produces for us $750 as the amount of interest expense that we're going to accrue. The next journal entry that takes place is on March 31st. And this is in the next year, so 2018. Remember, the interest, it's told to us in this problem, is paid semi-annually. So we need 6 months. If we're saying semi-annually, it's every 6 months or twice per year. So we need 6 months from the date of issuance. So we have October, November, December, then January, February, and March. So at the end of March, interest is required to be paid. Our journal entry at that point is going to debit interest payable. And the reason why we're debiting interest payable is because we're reducing the amount that we said we owed here. So we're going to get rid of that $750. We're also going to record additional interest expense. The additional interest expense is now between 12/31 to 3/31. So it's the additional 3 months that exist. And we actually already did a calculation for 3 months. That's this calculation right here. So we're just going to use that again. So I have an additional $750 here. And then our credit is going to be to cash because we actually do make our cash payment. Remember, we're paying semi-annual. And so this is half of an annual, a whole year's interest. And so we're paying $1,500. Remember, if we take $50,000 and multiply by 6%, that'll give us $3,000. So we're paying half of a year's interest here. Our next journal entry that'll take place is going to be on September 30th. So that's 9/30/18. And this is when the note matures, right? So the note completely matures at this point. So we can record this in 2 separate entries, or we could combine it. I'm going to show it in 2 separate entries to sort of highlight the 2 components of the transaction that's really going on, and that'll correspond with what your book does as well. So our journal entry for 9/30, the first one, is where we'll take care of interest. So we're going to debit interest expense, and we'll credit cash directly. We don't need to credit interest payable because we're not paying it later. If we're paying it at this point, then we can go ahead and credit cash immediately. Our calculation that we're going to do is going to be principal times rate times time, 50,000 times 6% times the time that has passed from here to here. So we have April, May, June, July, August, September, or 6 months. And we know that to be true because this is the second half of the year that we're now paying interest for. And this amount will be $1,500. It is the same as the amount we paid here when we were paying for 6 months too. The last journal entry that we'll then do is also on 9/30/18, and this is for the repayment of principal. So we're going to debit notes payable short term, effectively reducing that liability that we originally recorded, and credit cash to pay back the principal. The amount of principal here is $50,000. Same as what we recorded in the beginning.